Intel and Motorola killed a four-day rally on Wall Street. Wednesday's slide left investors jittery about whether or not it's time to re-enter the market. For some answers, I sat down with David Edwards of Heron Capital Management. So David, tell me why you think that the market will actually resume its growth pattern by the end of the year.
Well, there's a host of reasons why stocks should be higher right now. The single biggest weight on the market is the potential war with Iraq, which I think will actually happen sooner rather than later. My opinion is that fear has taken 15% off the S&P 500 and added $5 to the price of a barrel of oil. My opinion is the war will be over relatively quickly, relatively painlessly. There's many people talking about the things that could go wrong. I'm thinking about the things that could go right. Once that weight is removed, let's say by next March or next April, you ought to get that 15% back on the S&P pretty quickly.
So you're talking about actually a war that hasn't even started yet, but has really diminished some of the values of some of the stocks.
Absolutely. The two things that really kill the stock market is, one, corporate earnings collapsing, and we've seen that earlier in 1999-2000, and two, the outbreak of war. Once you get into it and you see how the cards are falling, be it the Gulf War, be it the war in Afghanistan last fall, investors tend to pick up pretty quickly. All
right, so we were talking about this. We're taking a look at an article that you wrote right here. I'm taking a look at it, and you're saying that there are ways to take losses while you keep your allocations, which is very topical right now when you look at what's going on.
It's tough to commit new money to the stock market right now, but if you're already invested, it's way too late to sell. One of the issues that confronts anybody who put money even into an index fund in the last 2.5 years is that they're down 45%. Let's say you're invested in the Vanguard Index 500 fund. You're down 45% from March 2000. You can either sit and wait till that regains, which might take 2, 3, 4 years, or you can take a tax loss on that fund and roll out into a similar fund that's not exactly the same, capture the tax loss, and use it in future years.
Now, tell me about wash sales, because you're saying you need to be a little bit cautious about those.
Right. If you have a position showing a loss in IBM, for example, and you sell it today and then buy it back tomorrow, you've triggered a wash sale, and the IRS will disallow that. You have to wait 31 days before you go back into the same or a very similar security. One thing that can trick people about index funds, for example, is that if you are in Vanguard 500 and you swap out into the Schwab 500 portfolio, it's effectively the same security. It's the same allocations to Microsoft, Intel, Walmart, etc. Different fund company, different fees, but you know what? The IRS might well disallow it. So if you're going to be doing tax loss sales in mutual funds, make sure that you're not swapping into an identical fund.
So let's also talk about tax strategies when it's an abnormal year, when things are just not tracking along the way they normally do. What should you do then?
With my firm, normally we take our capital gains in January. And that gives us the whole year to find offsetting losses if need be. We try and zero out our gains by September, October, and then be ready to go for the new year starting in December. This year, nothing has gone right. We're down 26% year to date. Most of our peers are down at least that much, if not more. We have no gains to worry about, but we know that the stock market will resume its upward course. And if we can't use those tax losses this year, we can take them indefinitely. One thing that many investors don't know is that you can write off the first $3,000 of a capital gains loss against your ordinary income and roll the rest over to future years, either against ordinary income or against future gains. And that could be a gain from the sale of a house, the gain from a sale of a business, whatever. You harvest your tax losses, you make lemonades out of lemon.
So really what you're trying to do here is just, you're going to have some losses. Try to get as much as you can out of those losses and keep them pared down. That's really the idea.
Right. At the same time, make sure that you keep your allocation in equities constant, because really I think the risk is missing the next upturn, not having a bigger downturn.
All right. Thank you so much, David Edwards.